market's resilience has been somewhat surprising. But, I think what's interesting is if you look at what's driven the market higher, it hasn't necessarily been the cyclical areas of, the recovery stories. And only just recently have we started to see airlines and banks and some of the more distressed areas of the market really recover. But so far, I think a lot of what's driven the market higher is just all this liquidity sloshing around looking for a home. And we've been in an environment where growth has been scarce, yield has been scarce, so the S&P has benefited. What's happening today in the market and over the last week or so is, I think, interesting because it suggests that the market is looking beyond the terrible data that's coming out right now in the U.S. and is really thinking about the idea that as we recover from this recession, some of these distressed areas of the market are pricing in a much more dire scenario than what's likely to unfold. Why am I worried, though? I think that a lot of what we've seen this year has been subsidized by the government, by the Fed, and by the corporate sector. Many companies in the U.S. are saying we're not going to lay off anybody this year. So I think that the employment numbers are artificially supported by even the U.S. corporate sector remaining fairly accommodative. There is this corporate stimulus that I don't think that we're acknowledging that's happening this year. And whether that continues into next year, if growth continues to be a little bit sluggish, I think that's the big question. And then, obviously we're heading into a U.S. presidential election, so there's a lot of, potential volatility that could be driven by headlines around China trade restrictions, civil unrest here at home in the U.S. So I just feel like this is a little bit of a calm before the storm.
Yeah, Savita, I mean, it's interesting. I mean, you said a lot there that I just want to pick apart. And I mean, I think the biggest thing is, when do you know to change direction, right? Like, timing this market is so difficult because people will continue to say, don't fight the Fed. Do you think it's going to have to be some sort of earnings wake-up call?
I think the catalyst might just be moving past this massive and unprecedented injection of liquidity. The one thing that I think is interesting is that we just tracked a chart looking at the Fed balance sheet versus the percentage of FANG stock as a market cap weight in the overall S&P 500, and it's basically the same chart. So I think that a lot of what we've seen, maybe 90% of this rally, has really been driven by liquidity, and then that 10% or so in the last week has been driven by reopening. Now, what causes that moment of reckoning? I think timing is everything. And, when I think about the calendar events that are happening this year, we've got a November election. We've got both candidates campaigning aggressively. We have Biden talking about reversing the corporate tax cut, which would be a big hit to U.S. earnings. So that's something that could cause more investor consternation. But, I just sort of feel like the headlines up till now have been generally positive and about reopening, et cetera. And now it's really when the rubber meets the road and we really think about consumer spending and taxes, et cetera.